All right. It's 1 o'clock. We're going to get started with SFR Talk. Hello, everybody, and welcome to SFR Talk. So excited to have you here today. Today's topics are going to be around the 2025 year of the market, what we're seeing, what we're doing here as a company here at HRG. Like to introduce myself first. I am Scott Heimel, I'm the SVP of Operations and Sales here at HomeRiver Group. For those of you that are new to us and don't know HomeRiver Group is the nation's largest third-party property management company. We manage multifamily and single-family homes across the country for folks that own one to thousands of doors. We love doing it. That's what we do here at HRG is all property management. Today we got a great guest and leader of the industry and here at HRG, Doug Dale. And we're going to be walking through a couple slides that we put together for you. And we greatly appreciate any questions that you got, any information that you want. You need more information on what we're talking about, please put comments in the chat. We're happy to field all the questions as we get towards the end of our presentation. So with that said, Doug, how about an introduction for you? And we'll move on with our presentation.
Sure. Scott, thanks for having me. I was joking with Scott when Scott suggested we come on and talk about the market. I said, well, how many slides should I put together? And Scott said, we only have an hour, like 5 to 10. And so I just sent Scott 20 slides with a bunch of data and stuff. So I think when Scott's saying, or please ask questions and everything, please do. We don't want it to be boring. We know this is right after lunch. So the intent here is to educate and help answer questions. So please don't be shy about asking questions. Before we get started, quick background on myself. As Scott mentioned, I'm a co-founder of HomeRiver Group. So I've been in the single family space for more than 20 years. Doesn't feel that long, but that's how long I've been doing it. I actually cut my teeth right out of college with a staffing firm. I sold that staffing firm, got into single family housing. And actually, Scott, I don't think I ever told you this, but the first deal I ever did in single family housing, I actually put a newspaper ad. Again, I've been doing it for 20 years, so I'm old. But I put a newspaper ad that we buy ugly houses and we buy houses, right? In a newspaper ad. One of the first phone calls I get, it's a couple, they had a rough situation. They need to sell their house right away. I ended up buying the house for like $75,000. I sold it like a couple months later for $130,000. And I was like, oh, this real estate thing's easy. I was wrong. It's kind of like everybody always wins the first time they go to a casino kind of thing, right? But so that's how I got started. From there, I scaled primarily rent-to-own business in central Indiana, grew that to about 1,000 houses, sold most of those kind of pre-credit crisis. And then I started moving into rentals. As I was doing more and more deals, I got introduced to what at the time were basically national asset managers. So these are folks that would do servicing and bundle up homes in some situations and sell them for banks. And at the time, banks and everybody were trying to unload REO. If you remember during the financial crisis, home prices pulled back in some cases 20%. So people were trying to get homes sold very quickly. I got introduced while I was doing that to some of the early institutional players. So folks who founded Invitation Homes, American Homes for Rent, Tricon, et cetera. And it made me realize two things. One, that institutional money was coming into the space and it was here to stay. And it was going to change the way we all worked within the space. And two, how critical operations are. So a lot of the folks we spoke to said, hey, we can't come by in Indianapolis. I'm based in Indianapolis because we can't get enough homes to justify our operations. So I viewed that as an interesting opportunity along with my co-founder, John Hirschfeld, our private equity partner, TZP. We said, what if we build a national property management platform so investors, big or small, can invest efficiently in all of the best markets, right? Rather than having the tail wag the dog, they should be able to, whether it's 1,000 properties or one property, invest their money where they think they're going to get the best returns, and we'll just deliver best-in-class service, and we'll generate operational scale in those markets so we can deliver the service more cheaply than anybody else, but still provide great service. So that's kind of the founding of HomeRiver Group. So fast forward, we're in 66 markets. I think we've done over 100,000 properties across the platform historically. We had an HOA business, which we sold last year. So that's a bit about me and a bit about the the company. So
Yeah, I do
I
miss
think,
the old days, right?
yeah, the old days. That's right.
The $75,000 here in Pittsburgh, we were getting them for $6,000 to $8,000. I miss those days, but they're long gone, and we'll talk about a little
Yeah.
bit more of that in our presentation today. So
That's, and by the way, for the folks who live on the coast, $75,000, $130,000 homes, certainly in central Indiana, I'm sure in Pittsburgh too, right, Scott? Those are nice homes and good suburbs at the time, right? Good school systems, et cetera. It was just, it was an opportunity, but boy, things have changed.
yeah, you can't find those $8,000 brick homes. They're long gone. So, but anyhow, so why don't we get into it and talk about market, what we're doing initially, and then we'll go through your data. I'll turn this over to you, Doug, and you can walk us through this. And again, everybody, if you got questions, throw them in the chat. We love questions. We want this to be an interactive phone call, not just us standing up here talking. So if you got something that you're interested in about the market or where we're seeing rents grow or anything like that, by all means, put it in the chat and we'll be happy to answer your question to the best of our ability. So Doug, take it away.
Thanks, Scott. Yep, like Scott said, please send in questions and we'll do our best to answer them on the way or at the end, however we can do it. So what's been interesting over the past 36 months, as we all know, interest rates have gone up at a historic pace. So what that did to the housing market was it really didn't, at least until the last 6 to 8 months, it really hadn't had an impact on pricing from a negative standpoint. What it did do is drastically lower the amount of folks selling homes, and it lowered the volume. And we're going to talk about that some kind of as we move forward. Our current view and consensus view is, despite the fact that rates have been higher for so much longer than anticipated, that we think there will still be positive home price appreciation nationally this year. We think there are going to be pockets where home prices will go down, and we'll talk about that. And we also think rents will continue to grow. Part of that rent growth is going to be supported by the fact that right now it's about 44% cheaper to rent a starter home than it is to buy a comparable property. So that is supporting rent growth. People are kind of staying in place. And we're also seeing that in higher retention rates. So for a lot of the publicly traded institutions, but also just single family in general, there are retention and renewal rates in the 70s and 80%, which is relatively historically high compared to what you've seen historically. So we think that's driven by the fact that people aren't ready to start buying, and we'll talk about where we think interest rates are going. Scott, can you go to the next slide there? And then one quick call out. A lot of this data, a lot of these images are coming from John Burns Real Estate Consulting. We're a client of theirs. They've done great work. I also pulled some from Arbor Loans, and then we have an internal data analytics department that we're trying to be more thoughtful about bringing data to clients, and such as yourselves. So it's kind of the mixture of all of that data, but wanted to make sure everybody understood. So to start off, wanted to make sure we level set. So as I mentioned, the activity in the housing market and the resale and the new home housing market has been very low over the last 36 months. So the image on the left is the seasonally adjusted and non-seasonally adjusted, basically the units sold on a rolling 12-month period. So you can see that on the left. And while it looks like we're sort of going sideways, what I would call out is we're at about to the same volume as we were in 1997. And in 1997, the US had 70 million fewer people. So if you think about it in that context, we're really not selling a lot of homes as a percentage of the population. I think the comparison on the right is even more stark. You can see that, since 1983, the existing home inventory for sale, the homes on the market are still near historic lows. So everything we talk about today should be held in that context, that we're really not seeing a ton of inventory. There is supply in certain markets, but nationally, there's still a lot of markets that just don't have enough inventory. And when that occurs, it supports home price appreciation, supports rent growth, it supports occupancy in single family rentals. Can we go to the next slide? So the image on the left there is a breakdown of new builds, basically new spec inventory and existing new homes. And then the image on the right is total housing inventory. And the reason I wanted to show this is you'll probably see a lot of headlines, or probably have seen a lot of headlines about there being a ton of new home construction, and it's spiking. It is getting back to near historic highs. That's true. But if you look at the right, even though it's a higher percentage of total housing inventory, the overall inventory is still very low when you look at it from historical perspective. What we are seeing is new build inventory in certain markets spiking, and places like places in the Sun Belt like Florida and Texas, they are already past pre-2019 levels of inventory, and that's starting to manifest in home pricing. But nationally, we still have relatively low inventory on the market. Scott, can we go to the next slide? So part of what we want to drive home is when rates fell through the floor during COVID and kind of stayed low for an extended period of time, a lot of folks understandably either purchased a home or refinanced a home. So as a result, something like 83% of borrowers have a rate below 6%. That in a housing market creates what's called a lock-in effect. So basically people aren't looking to buy a new home or aren't going to refinance, obviously, because their rates are so low. So they're not selling homes and they're not necessarily looking to buy homes. The image on the left is just a breakdown of each individual cohort. The image on the right, you can see is rates went down and we're past the peak. So we're starting to, as people have life events and things, their rates change. But right now, we still have a significant amount of people whose rates are below 6%, and the most recent mortgage rates are around 6.7. So if you think about that many people with rates that wouldn't benefit from a refinance or a purchase, you're seeing a lot of people who don't want to move. You want to go to the next slide there, Scott? So the image on the left is showing what the average, how many people, how many households could afford a mortgage balance at what rate. So that top line there is just a mortgage. They're basically various mortgage balances. But what it's telling you is right now, we would need to move, or we have about 49 million people, households, excuse me, about 37%. Who could afford a $400,000 mortgage. Now, the median home price is around $400,000, depends on what you're looking at. So about 37% of the population could comfortably afford that. If rates move down to 5%, another 11.4 million households could afford it. Now, on the right, you can see the different views on where mortgage rates are heading. By the way, that continues to get updated and softened because some people are starting to think the Fed may cut up to 3 times this year. That just changed this week, but there's a lot of back and forth, right? And there's a lot of stuff going on with tariffs and everything else. So that is constantly changing. But the general view is that rates are going to come down a little bit this year, but not enough to bring a significant amount of home sellers and buyers into the marketplace. But we are going to see some inventory increase. Scott, can you go to the next slide, please? So this is just a chart on delinquency. So even though we're talking about the fact that home prices and mortgages have gotten more expensive, the consumer actually, by most measures, is relatively healthy. So if you look at on the left there, you're seeing different consumer loans, mortgages, credit cards, student loans, auto loans, HELOCs, etc. The default rates and delinquency rates are still extremely low. Right now, what we're seeing is a mortgage default rate of less than 1%. We're seeing student loans have fell through the floor. One thing I would call out there is, remember, there's a lot of talk around forbearance for student loans and whether or not we were going to forgive student loans. That looks to be getting reversed. So what we may see in the coming months is actually that delinquency shoot back up because people hadn't been paying their student loans. So it's something to keep an eye on. I think consensus view is that something will be done so that the people who didn't make payments, aren't punished or in a bad situation, but that delinquency will probably bounce back a little bit to where it had historically been.
Yeah, and this is
the chart.
This
Go ahead,
is a
Scott.
surprising slide to me, Doug. I would have made a guess or a bet that with the way inflation has been and interest rates going up and the amount of people who had an adjustable rate mortgage, I thought we would have seen the uptick a little bit in foreclosures, but we're not seeing that, which is actually a really good sign, but also wondering why. So
yeah, no, it's a great question, Scott. There is some chatter. There have been some government forbearance programs that have been used for folks with the FHA. Though that is a very small percentage of the total outstanding mortgages. There are like 51 million outstanding mortgages, give or take, in the United States at any given time. The delinquency, people are able to afford their existing mortgages. And I think the other outcome is if people are getting into situations where they're in trouble, they can still sell their home and they still have embedded equity. So I think what you're seeing is the people who maybe are struggling or are able to sell their home. A healthy housing market typically has anywhere from a 2 to 4% kind of delinquency and then eventually foreclosure rate. So we'll see that increase, but I agree, Scott. I was expecting more distress than what we're seeing. The graph on the right side, this is kind of a detached way to get to this, but basically this is a graph showing the delinquency rates of SFR CMBS, so commercial mortgage-backed securities. So when large single-family operators are bundling up their debt, they're getting ratings and they're being tracked by rating agencies. And what you're seeing is that delinquency rate continues to go down. So that tells us kind of two things. One, the borrowers, the large operators seem to be doing well, and they're most likely doing well because people are paying their rent, right? So we're seeing the consumer on the mortgage side paying their bills, and we're seeing the folks who have rental properties and rent pay their rent. We see it in our collection numbers, Scott, right? HomeRiver Group's usually collecting 97, 98% of their rent in month. So it's not surprising to us, but I think a lot of people don't appreciate, even though inflation has been so strong over the last few years, people are still paying their bills generally on time. Scott, you want to move to the next slide? So given everything we just talked about and the fact we think rates are going to move down a little bit, most people's view is that we are going to see an increase in home sales, resales, and existing home sales over the next few years. Again, we're coming off historic lows, so it's still going to be below the average, but it is going to increase slowly over time. Now, there are certain markets in the United States, especially in the Sun Belt, where inventory is going to rise faster, and that could have a negative impact on home prices. But generally across most of the country, inventory will stay, while it will increase, it'll stay relatively tight. Scott, can you go to the next slide? So I know I've been touching on the Sun Belt. So what's interesting here, so the slide on the image on the left is the resale housing market, whether or not sellers or buyers are outnumbered. So if you notice Southern Florida, Northern Florida, Texas, and the Southwest, generally sellers are outnumbering buyers. This is done by surveys and other items. This is how they arrive at this data. But the rest of the country, it's still generally a seller's market, right? But Florida and Texas, it's especially acute where there's just a lot more sellers. Additionally, the view on where prices are headed, you can see Southern Florida, Northern Florida, Texas, you're seeing mostly decreasing, or seeing a large portion of people thinking they're mostly decreasing. The other piece, and we'll touch on affordability later, is those are also the markets that have been hit the hardest by insurance. So of all the costs to own a home in the United States, insurance has moved up the fastest of all the costs. It's not principal, it's actually not interest, it's not taxes, it's actually insurance. So on average, insurance increased 14% year over year, and it's increased 61% in the last 5 years. And it's especially acute, obviously, in Florida, Texas, places that have hurricane issues, things like that. But it's also in odd places. I think Seattle had the largest year-over-year increase last year in insurance premiums, which is a little odd. But move to the next slide, please, Scott. So although we're going to see inventory, and although we're going to see those Sunbelt markets potentially have a pricing pullback or very modest HPA, if anything, we still think, again, broadly, we're going to see appreciation across the United States as a whole. And this map on the left, this is from November 24, but I think it's a good visualization of what we're saying in the housing market. It's sort of the inverse of the last 6 to 7 years, where the Sun Belt was growing the fastest, the home prices were going up the fastest, there was the most new construction, the most population growth. So they were kind of doing the best. Now they're sort of pulling back faster. And we'll talk about why we like the Midwest and why the Northeast is holding up. But generally speaking, you're seeing those pullbacks in the Sun Belt, and you're going to see the Midwest and Northeast most likely kind of stay steady and grow a little bit. We can go to the next slide. So Scott thought it might be helpful if we talked about our joint venture. So the HomeRiver Group raised a couple $100 million in December of 21. Actually, John Hirschfeld, Drew, and I were on a phone call on New Year's Eve of 21 closing the deal. So we literally were late to New Year's Eve parties, but effectively launched it in 22. Part of the reason we did this is because we wanted to prove to our clients that we can operate properties while we understand their issues. We wanted to build out the service for clients because we want clients to feel comfortable that we can do everything from cradle to heaven, right? From acquisitions, renovations, leasing, maintenance, management, to even dispositions. So this is a great way to prove it. The other piece is we are investors at our heart, and we've always wanted to be able to raise some money and take advantage of the platform we built. And so this has been a great way to do it. We thought it'd be helpful to share with you guys how we're viewing the market and what we consider as we're doing acquisitions. So we're looking for markets with positive long-term demographics. You want strong population growth. You want diversified industry. You want a positive place to operate a business. And then within those markets, we're looking for 3-bed, 1.5 bath homes, 1,000+ square feet, built post 1979. And we're targeting price points that are generally in the median income and affordability in that market. All of that is created because we believe if you're buying in a market that is consistently growing, it's a good place to operate, where people can afford to either buy or rent, and they can afford gradual rent increases and home price increases. Then you're set up well to succeed in your investment. I
And I
think you
think,
probably periodically see us send you emails as well. We buy homes from clients all the time. A client will just say, hey, I got to sell the home. I have a tenant in there. I don't want to move him out. Do you guys have any interest? And so we buy from clients all the time as well. Go ahead, Scott.
yeah, I think what's interesting too, on this slide is that, we're not shying away from some of the houses where, some of the areas, such as the Floridas or the Texas where, insurance and some of those other affordability measures come in when it really affects your rates of return, because we still think that we can make deals work in those markets. And I believe that if you're doing it correctly and you're really looking at, your expenses with those, you can still make those deals work in those markets. Even though I will say that Florida in particular, with the rising insurance cost, it's becoming more and more tougher, but you still have the ability to be able to really get a good solid rate of return. It's still a fairly strong market. And I've noticed a bit of a trend lately with some of the institutional players out there, and we're not that they're going to more or less climate impacted markets, which is really interesting, and it's probably the next play, which kind of goes back to your comment earlier when you said that that Midwest market's really going to start to see some increase in appreciation and rent values. That's where a lot of people want to go right now. There's a lot of people tired of dealing with the climate related things.
Yeah, I totally agree, Scott. There is a big trend in the industry, you're right, where they're looking at, hey, where are the less climate impacted markets? I generally think long term, we're still believers in Florida and Texas long term. We think they'll still have population growth, but they are going to have to figure out the insurance market, to your point, Scott, and they're going to have to continue to address construction and building codes, right, associated with high wind damage and things like that. And you're right that I think that'll draw more population back into the Midwest and some of the other markets as well. And that's part of the reason we think when people are investing in single family real estate, they should have a diversified portfolio, right? Like if you're going really heavy in one market and something bad happens in that market, it's a little tough, right? So that's also our suggestion on, hey, picking a few different markets where the long-term demographic trends are strong, so you're diversified a bit. But Scott, can you move to the next slide? So we referenced this earlier. The occupancy in single family rentals has been strong over the past few years, but it's inversely correlated, and you can see it on the right hand side. It's inversely correlated to the amount of for sale inventory on the market. So you can look at that. It's almost an exact 1-to-1 inverse correlation. As for sale inventory goes up in a market, rental occupancy typically goes down. So over the past few years, as there's been tighter inventory, rental occupancy has done well. And as inventory is going up, you can see it coming down. Now, that doesn't mean that your rental properties all of a sudden have an occupancy issue, but it can be impacted, right? And so most people don't appreciate how related those two things are. I hear some people talk about the fact that, oh, when the sales market is really bad, then the rental market's really good. Some of that is correct, but there's also this relationship to, if there's a lot of inventory on the market, you're going to have occupancy issues. And then if you're having a lot of inventory on the market, people will convert some to rentals and they'll do other things. You may not see as much rent growth. So you have to be mindful of that relationship. Scott, can you move to the next slide? So on the left, you can see sort of over the last, from 2016, historical occupancy. This is just the broad SFR occupancy rate as reported by the Census Bureau. It's hovered around that kind of 93 to 95% range. We're seeing it nationally go down a little bit as more inventory comes into the market. Now, we're seeing on stabilized homes, it's a term you may hear us talk about. These are homes that have been renovated and homes where HomeRiver Group has placed a screened and appropriate resident in the property. Stabilized homes maintain, mid 90s, high 90s occupancy when you're managing them well. But the broader market also consists of some vacation rentals and other things. and you see that broad occupancy coming down some. The other thing that I thought was interesting is on the right-hand side is sort of a heat map of markets and their year-over-year rental change and their occupancy. And you can see on the right-hand side in the upper corner, places in the Midwest have seen over the last year, they saw the best rent growth, and they also maintained high occupancy. That's related, right? When there's not as many units available to rent, then you see more rent growth and you see higher occupancy. We can go to the next slide. So this is the rental yield. This the slide or the image on the left is maybe a little boring, but I'll tell you why it's interesting. So with any asset class, anytime you're investing in anything, they usually talk about a risk premium, right? Or what they're basically saying is how much more of a return do I need to get if I'm going to invest in this asset versus a risk-free rate of return, just basically treasuries or something like that. This maps out how many basis points or what the spread is between or investors expect between a 10-year treasury and a single family rental, and a spread between a single family rental and a multifamily. What's telling to me about this is you can see over the last 8 years or so, over time investors have started to perceive single family rentals. They've understood that they are not as risky as they initially thought, so that premium is coming down. On the multifamily side, you do see a bit of a mixture. The other piece of that is that's extremely interest rate sensitive, and they trade based on cap rates, which is purely interest rate sensitive. On the single family side, there's a bit of a mix too, because you can see during COVID, when rates were cut, the rents didn't keep up with home price appreciation as quickly. So that's why you see that spread increase and then go back down. That's rents catching up with home price appreciation. The image on the right is just showing what the gross rental yield is across the United States. And to Scott and my point earlier, you can see stuff in the Midwest generally has a higher or gross rental yield. And you also see that these are still generally affordable markets, which is why we like them, at least in the short and near term.
Yeah,
you can go to the next slide, Scott.
I think that relates a little bit to appreciation rates, at least historically, have not been very high in these markets in general versus some others. So, again, in Pittsburgh, we probably average about a 3.5 if we're lucky annualized appreciation rate. So, when you start to get people moving and your appreciation moves, your rent tend to stabilize. They grow, but then they end up stabilizing. So I think some of these markets are actually catching up because they haven't appreciated quite as quick as others.
Yeah, totally agree. Scott, you can go to the next slide there. So the image on the left is breaking down single family rent to income ratios. So we talked about affordability a little bit, and we talked about the impact of insurance, by the way, which tenant insurance does not really get impacted by weather much. So that's another benefit of somebody when they rent a home. But you can see in the Midwest, you're generally still around that 25 to 35% range of rent to income, which is generally considered relatively affordable, right? The image on the right is the ratio of for sale housing cost to income, and then it's overlaid with single family gross rental yield. And again, what you're seeing is in the upper right hand corner, buying homes is still relatively affordable in most of the Midwest markets, and then you're still seeing a decent rental or gross rental yield. And as we mentioned earlier, we believe that sets up a market for long-term rent growth and supports home price appreciation because people can afford it. Now, we're talking a lot about the Sun Belt. We are still believers in the Sun Belt long term. We're talking in the near term, incomes are going to need to catch up and rates are going to need to come down for those to kind of have sustained growth again. But over the next 12 to 18 months, we think, given where rates are and given how inventory is starting to shape up, that's going to negatively impact occupancy and home price appreciation. And then long term, they'll catch back up. But this data is telling us there's room for the Midwest and even some places in the Northeast to continue to grow while everything else is sorted out. Move to the next slide, Scott. So this is John Burns' rental projections, like we were talking about. Miami, they actually are still bullish on. I'm not sure if I totally share that view because there's been a ton of building in Miami. We could probably do an entire webinar about Miami, but what we see in the Midwest is strong fundamentals to support rent growth and affordability. So we're comfortable with that rent growth projection for 25. And then the image on the right is John Burns' view on 25 through 27. And you can see, as we were referencing, the Sun Belt does bounce back, right? So they may have some negative rent growth and some negative home price appreciation kind of throughout this year. But then over the next few years, they will come back. And that's, as a reminder, they had seen the most outsized in market domestic migration as well as international migration into those markets, and population growth will catch up with it. We also believe they'll figure out the insurance markets long term, but right now they're still sorting those things out. So in the interim, you kind of see more steady results from the Midwest and some of these other markets, and then the Sun Belt will catch up. Scott, you can go to the next market or the next slide, please. So when Scott Heimel and I were talking about, hey, which markets do we like? So we're in, and our JV is buying in all these homes. So we're putting our money where our mouth is. We are buying in Indianapolis, Cincinnati, Columbus, and Raleigh, Durham. We're also buying in some other markets too. But we've seen just from our own book, seeing relatively high occupancy rates. The collection rates have stayed strong, and the retention's been strong. The retention's interesting because that tells you people who are staying, they want to stay in place. They don't want to go try to find a new place to live because they don't think it's going to be cheaper, right? Or they think they may not be able to find a place in general. And the image on the left, all those images on the right come from our internal metrics, and Heim will dive into that too some more. We're seeing people start to renew further ahead of their lease expiration, which tells Scott and I there's demand in the market to stay. Right, people want to stay where they're at, and they're willing to pay some rent increases. Go ahead, Scott.
Yeah, and I mean, our rent increases have been really good. They're actually following the Burns data really closely with our rent increases, and we've been, as you can see from the graph, the bottom left, we've been about 50 days out in advance on renewing leases, which tells me that folks are wanting to stay longer. There's not a lot of movement in these markets, which is great. So if you can find something, you're going to get a few years out of that tenant, which helps on your returns, and a stabilized SFR property that you do not have to turn every year is really where you want to be. At least I always did. I tried to keep my tenants in there for as long as I possibly could, while still getting the necessary rent increases. So we're seeing that same data. We're renewing at about an 80% clip, every single month across all of our markets. That does include our month-to-month leases. We do consider that a successful renewal, but 80% is pretty good. We'll take that pretty much any day of the week. Typically, when you talk about renewals and tenants, you're going to get around 10% that want to stay month to month. You're going to get 10% that vacate. If you can renew that remaining 70-75%, you're doing really well. And we're hitting all those numbers pretty consistently. So we're really glad to see where we're at with our renewal work and keeping people occupied.
Yeah, it's great. I know of at least one question we've gotten on ADUs, which I'm happy to touch on, but are there any other questions, Scott, that we've gotten in?
Yeah, we got a ton of questions actually. So I'm gonna start in no particular order. There was a questions, regional differences in sales versus rent, particularly Florida, which then was followed up around regarding Florida and Orlando. You mentioned inventory for sale high. You referenced 2019. So I think we could probably tie both of them together.
Yeah. So the reason I say 2019 is basically I'm saying pre-COVID, right? So inventory levels in Florida and Texas, basically every major market in Florida and Texas are above pre-COVID levels, right? Before COVID happened, and those inventory levels continue to rise. And then what was the other part of that question, Scott?
The regional differences in sales versus rentals, and then there was that one. And then regarding Florida and Orlando, you mentioned inventory for sale is high. And we're seeing that across Florida. I can help with this a little bit. There's a lot of sales inventory on the market in Florida right now, which is actually driving our days on market and our occupancy down. And we're seeing that on the rental side. A lot of the stuff that we're seeing when folks are terminating and going to the sales side is really all around affordability. It's getting really hard to afford a rental property in Florida right now with the insurance. I think that once they fix the insurance stuff down there and get that stabilized, you'll start to see that return to a little bit more stable on the rental side. But affordability has been our number one answer when owners want to sell in Florida.
Yeah, that's true. So I agree with everything you just said, Scott. I found the question pop-up thing, by the way. Thank you.
Yeah.
So that's I agree with everything you're saying. So inventory is above pre-2019. Like Scott said, I think they solved the insurance thing long term. The other piece is, Governor DeSantis has been talking about lowering property taxes. And I think it's pretty clear to him that the housing costs have gotten so high in Florida because of insurance that he's going to need to do something, or he's going to have an issue with population growth in the state. He hasn't overtly said that, but I think that's part of his thinking. And the general view is that property taxes will come down on some level in Florida. I think that benefits investors and it benefits homeowners too.
Yeah, and there is a question on there about Texas, which Texas needs to follow suit. Their taxes are becoming a bit of an issue in Texas. Fortunately, there are a couple companies out there, and I'll see if I can't get the some information out to you that will actually help you go and lower your tax rates. Their success rate is pretty good. Obviously, what you want lowered and what you actually get are two different things. But at least if you get something, it's better than nothing. But the taxes in Texas have really played a part in some of our terminations too. Are you seeing that on your side, Doug?
Yeah. Yeah. I have Texas. By the way, you mentioned the property tax in Texas. There was something in front of the legislature, I think it was last year, to try to lower and cap property taxes, which may get passed, which would help a ton, right? And if you look at the operating expense ratios in Texas, they are the highest of any of the states because of those taxes typically.
Yep. This is an interesting question. I've seen this come up before. And how are institutional investors affecting our SFR opportunities? Which is an interesting question. I get that a lot, saying, and you hear it on the news, right? The institutional folks are buying all the available housing and turning neighborhoods. And I think that if you shared the stat that we saw, which was there's 20 million single family investment properties, of which I think only like 2 million are owned by institutional investors, or maybe that it's less, Doug. I can't remember off the top of my head, but when you look at that, I go, well, maybe they're not buying them all. I think there's deals everywhere, right?
Yeah. So I hear this periodically, and then I see like the TikToks and I see like stuff on Twitter, right, talking about BlackRock. First of all, it's not BlackRock, by the way, guys, but that owns all these houses. They literally, if you look at it as a percentage of single family homes, institutions own like less than half of 1%, right, of the total single family housing stock. And as far as how do they impact, they do have an impact in certain submarkets within certain areas where they're buying a lot of properties, right? There are studies where people have tried to point out that they have higher eviction rates. If you look at what actually happens, though, they don't have higher pull-through on their eviction rates. They do file notices on collections and stuff. I'm kind of talking about what people have said historically are negative impacts. Generally, what we've seen as a result of institutional investors' involvement is that it's brought money into the space. So it's improved technology, right? It's improved our relationships with our residents. So we're now have a really interesting resident benefits package that I think is a result of institutional money coming in and saying, hey, we need to have a better relationship with our consumers and bring them value for staying in the homes. That's what, Scott, we're launching an internet package for our new residents, right? And we'll try to roll it out for existing residents eventually, where we can bring bundled internet to them cheaper than they go get it on their own, because we figured out how to do it. So I think the largest impact institutional investing has had is it helped bring money into the space, into technology and other ways to bring value to the residents. And I think all the other noise about are they impacting home prices and all this other stuff, they're just such a small part of a huge marketplace that it's just not really real. There's probably some one-off neighborhoods people can highlight, but generally speaking, the market's so large that they're just not moving the needle from a pricing standpoint.
Yeah, I would agree with that. And I do completely agree with bringing a better experience to the resident. And I think it's something that's actually been overlooked. And I've been in this market, in this business for 27 years, and I've never seen more of a focus on the tenant experience like I have over the last, call it 8 years. It's been really, hey, we need to have a great tenant experience. We want the tenants to stay longer. We want them to enjoy, it's our mantra, right? We want people to love where they live and love their home. And I put a lot of that on the institutional players. They want to retain those tenants, and we should all want to retain tenants in the end, right?
Yeah, that's right. So I see my buddy Barry Wilner put a message in there. I don't Barry is either messing with us, Scott, or yeah, I think he's got some real questions. He's sitting in Las Vegas. So as Barry knows, we have not made it. That's one of the few markets that Heimel and John and all the HomeRiver group, we haven't made it to Las Vegas yet. I actually do like Las Vegas long term. I do think there's solid rent growth. I think last year it was 5% rent growth. I think it's still projected to have more rent growth. I think there's some growth there in Vegas. I also think industry has been diversified. It's obviously still heavily gaming, but there's movie industry, sports, and other stuff going into Las Vegas. So we believe in Las Vegas long term. So I think it's an interesting market.
Well, the Sphere is there too. I mean, you can't.
And the Sphere is there,
Yeah.
right? Which
Yeah.
I've still not seen. I've got to make Barry take me to the Sphere, by the way.
Barry will take 2 tickets if you're listening.
Yep.
As an out-of-state investor from California, what's the best way to acquire a property through HRG? And I'm happy to take this one. A marketplace or ability to work with local realtors. FYI, HRG already manages a couple of my properties. Thank you, Sue. Glad to hear that we manage a couple. We would love to get you some more. I will tell you that really soon, hopefully within this year, we will have a marketplace and we will make it available for all of our clients who raise their hand to say they want to sell, for us to be able to take that property and put it up and say, hey, does any of our investors want this? So here's a history of the repairs. Here's a history of rent. So you can actually make a really solid decision on whether you want to buy another property or not. We are actively working on that. One would think it would be really simple, but there's a lot of tape to go through there because you got real estate laws that are different in every state, whether you're an out-of-state buyer. So there's a lot of stuff to work through on that, but we are actively working on it. We think it's a great way to help our investors and get people to buy more rental properties. I will tell you again, doing this a really long time, I've owned almost 100 properties at one point in time in my life. It's really hard for the local agents to find investment properties. Most of the time what you end up seeing is, sorry, my dogs are barking in the background, so I apologize if you can't.
They love rental houses, Scott. It's fine.
Yes, they do. They're a cheerleader of it. But the local realtors who are wonderful, what they do, they sell homes and they help you find homes to buy. A lot of them do not know how to figure out a rate of return, and you get an MLS feed turned on, and it's up to you to find those properties. So if you don't have the tools to buy them, you're never going to be able to figure out a rate on your own, and you don't have much assistance. So we want to help with that. We want to be able to get people to find properties to buy. So thanks for that question, Sue. All right, Barry's got a lot of questions in there and comments. Let's go with the next Barry question. What is your thought on Las Vegas? We just talked about that, so I'll mark that. Property taxes we talked about. Here's a good one, Doug. What do you contribute your high retention rate to compared to build for rent, which is more like 40 to 50%, primarily due to turnover from home purchases?
Yeah, it's a good question. So build for rent, it's interesting they're seeing lower retention rates. We are still, and I feel like it's early days too, to be honest with you, newer communities, I feel like retention will stay higher. I also think your maintenance and CapEx profiles are lower because the homes are newer and you've got builder warranty and a bunch of other stuff going on. We're seeing comparable retention rates in build to rent. I think our renewal team has done a great job of getting out in front and offering multiple solutions to folks who want to renew. I think another thing that drives higher renewal percentage is being responsive on maintenance. So the home, like when you survey residents, one of the big things they want is communications and maintenance solutions. And I'm not saying we're perfect, but we do a good job and we try to address and when you're addressing their maintenance items and when you're staying in communication with residents, they tend to renew. I think the space in general has seen high renewal percentages. Now, multifamily is much lower. Multifamily has a higher turnover rate. Those folks are a little bit, I don't mean this in a bad way, they're a little more transient. That's just where they're at in life. They may prefer to move around. That's why they rent an apartment. Single family just typically has a higher retention. But in summary, we think staying in good communication with your residents, trying to bring the residents value, being responsive on maintenance, that helps drive retention.
Yeah, I agree. And especially with single family, it's why I always love single family versus multifamily. And not that there's anything wrong with a multifamily investment, but you tend to get longer stays out of your tenant, especially if you're doing the maintenance and you're taking care of things as they come up. Tenants appreciate that and they tend to stay a little bit longer. So let's go to this next question that we got here. Sorry, I'm digging through them. You mentioned adjustable rate mortgages. What percentage of the mortgages are adjusted rates? I think that goes back to your slide. Was adjustable rate blended in with that slide on the mortgage?
HELOCs are in there. Let me see. I don't know if it has the percentage. Probably Barry or somebody on the phone actually probably knows what percentages are HELOCs, but or ARMs, variable rate mortgages. But as far as delinquency on HELOCs is low. As far as the percentage of ARMs, we'd have to look it up for you guys. Sorry, I just don't know it off the top of our head.
Thanks. As an out-of-state investor from California, what's the best way to acquire a property? And we did that one. Sorry, guys, I'm trying to get through these. I usually don't do the Q&A. What solutions are there to leverage scale and decrease insurance expenses in markets such as Florida and California?
So that's a great question. We are doing on the institutional side of the business. So these are like household private equity and asset managers. These are folks who are buying 1,000+ properties. We have a shared policy with our insurance provider, Alliant, and that is a much reduced rate because they can kind of pool the risk, and then there's not as much basically margin in between you and the person issuing the insurance. That has a higher deductible because it's institutional insurance. Like deductible could be as high as $50,000. What we are trying to do for our clients currently, and we're working through all the logistics and legalities and all this stuff, is bringing a insurance solution to the retail customer as well. Probably be anywhere from $1,000 to a $5,000 deductible. That'll help pool the risk better and bring pricing down for everybody, including the folks in Florida and California and Texas. So we are working to leverage our size to do it, and we're hoping to roll that out this year.
Yep, great. How has the data changed your ongoing maintenance projections? Second part, how has this changed your ongoing maintenance strategy?
Good question. So the first thing I would say about maintenance, and I think they figured out on the institutional side maybe more overtly as they were talking to the capital markets, you have to renovate. If you want to lower your maintenance profile and the amount of maintenance you're doing every year, you have to address your deferred CapEx. Basically, you got to rehab the home, right? So if you buy a home and your furnace is 15 years old, you're probably going to have an issue in the next 5 years with your furnace, your AC unit, right? At the very least, you should get it serviced and looked at. Same thing goes with a water heater, with a roof, with windows, etc. So when we look at maintenance calls, they're largely around HVAC, plumbing, and electrical, right? And then roofs. So when you're buying a home, one thing you can do to lower your ongoing maintenance is to do the renovations up front. So with our joint venture, we have a set of rules. We're basically like, hey, approximately here, guys, if the HVAC is 12 years old, go ahead and bid to replace it, right? If the water heater is more than 5 years old, bid to replace it, right? If the roof looks like it's got less than 10 years, bid to replace it. All of that's factored in when we buy the home so that we just do that renovation up front. That has helped us maintain a lower maintenance profile, and I would recommend that to everybody. If you try to just put, Band-Aids on things along the way, then your maintenance is going to be more expensive. It may make sense for you if you're only holding it for a few years, right? But you should expect more maintenance because the older things get, they're going to break more. You're going to have more maintenance calls, etc. The other thing I would flag is as we've grown and dealt with more maintenance calls, we've gotten better at working with residents in home to walk them through the standard issues, right? Like, hey, my garbage disposal isn't working. Hey, did you try a hex key underneath it? Did you do this? Did you do that? Here's how to flip a breaker, right? So we try to help with those things. And then we try to recommend, preventative maintenance. Part of that resident benefit package, we send them filters every month. Change your furnace filter. We check in on them. Those types of things help deal with keeping your maintenance profile lower. Go ahead, Scott. Sorry.
Yeah, no, all good. That was one of the things that I always have done when I purchased a home. I did the same thing. If I can do it now and bundle it into the initial debt of the home, that means that I have 15 years on an HVAC before I need to replace it if everything goes right. Same with the roofing and the big ticket items. If you can get those out of the way first as part of your initial financing, you will get some stability out of the maintenance. So it's always a great thing to do. You mentioned that it is around 40% cheaper to rent than buy a comparable home. How long do you think, excuse me, how low do you think interest rates need to go in order to tip the scales where that renter is now a home buyer?
So it's a good question. I don't know the exact number. I think ballpark what people think is what gets the housing market moving again is rates in the fives, because of what we talked about earlier about how many people have a rate below 6% and all of those other things. That number, just put it in dollar terms, that spread is about $1,019, I think, is roughly the spread when I said it was 44% cheaper. So that gives you an idea of how much monthly payments need to come down. Most assessments are saying it's around 4 to 5%. It's going to vary by market, guys, right? Because your median rent varies, your median price point varies, those types of things.
Yeah, we love the questions. So if you got more and you want to submit them, we got 10 more minutes. I'm going to try to get through all of them today if we can. If we can't, we will follow up with you with a separate answer. There was a question earlier if we're going to share the slides. We do share this actual, if you registered, you get the actual call. So you can go through, and if you need the data from the slides, you can pull it from there. We will not be sending out slides separately, but you will get a copy of this entire call for your convenience. Do you ever do rent to own? I'm gonna leave it at that. House does work and compared to a straight rental or sale. I could probably answer some of this, Doug. And then I'll let you feed in on that. Me personally, I have always struggled with rent to own. And I think that the courts, in my opinion, have not quite figured out rent to own versus an eviction versus a foreclosure, and it becomes very difficult to get somebody out that hasn't paid. That has been my personal experience with rent to own in Pennsylvania. It is nice. You can get a big chunk up front. And again, rent to own is a different type of investment strategy. So it depends on what your investment strategy is and if that works for you. I'm not saying it doesn't work, but there are some pitfalls to rent to own, but there's also some upside. So Doug, I'll let you answer. I just wanted to share my quick experience with it.
Oh yeah, thanks, Scott. So on rent to own, so I was doing a bunch of rent to owns as I referenced. Scott's right. There's a bunch of pitfalls in that. There's in Indiana, as an example, there's something called the Sketzel case, which basically said, hey, really put people to sleep post lunch. Scott, let me talk about legal stuff too. On a rent to own, if a lot of what people would do is they would take a portion of that rent and apply it towards the purchase price and then a portion towards rent. And what most courts would say is, well, that's functionally a land contract. You're financing the property, right? So you have to Scott's point, you have to really understand your local views on rent to own. You have to structure that agreement appropriately. I did well on them, but I just think you need to be cautious when you're doing them, and you need to make sure that you disclose everything clearly to the resident buyer so they understand what they're paying for and what they're not paying for. I actually think there's a room in the marketplace for rent to own when it's done appropriately and disclose to consumers, because some folks just aren't ready to buy or they haven't saved for the down payment, but they love the house, right? So I love the idea of bringing that solution to the marketplace. You just have to do it the right way.
Yep, agreed. Is there a person or team at HRG we can pose questions about 1031 eligibility to? The short answer to that is yes. The longer answer is we actually had a SFR talk around 1031 exchange. Their contact information is in that. You're an anonymous attendee. So if there's going to be some contact information at the end of this, if you want to send us your contact information, we'll be happy to get you connected with a 1031 exchange person that can help you along with that. We are not 1031 exchange experts. We probably know enough to be dangerous, but I always recommend dealing with the experts on those things. They will get you in a much better place, but we're happy to provide you a name of somebody that can help you. The most neglected maintenance is routine maintenance. Establishing that routine will save you money long term. I couldn't agree more with that statement. I think that you need to get your HVAC serviced. What I have found is that you get a lot of landlords that want to leave the routine maintenance to the tenant. Hey, they should care about the property, and it's probably not the best way. If you're servicing your equipment, the tenant sees that the landlord cares, and hey, every summer they sent, or spring or winter or whatever the case may be, somebody in to tune up the HVAC. People appreciate that, especially tenants, and that's what gets you your renewals and your long term. Hey, if you go mulch for them every year, man, they love it. Oh, they freshen up the house. They care, the landlord cares about the property. It tends to make the tenant care a little bit more about the property as well.
Yeah, Barry did answer. 18% of mortgages outstanding are ARMs, by the way, as of Q4 of 24. So to answer that previous question.
What are your thoughts on getting into Warren, Michigan for buying buying in HRG property management, used rental market there. So we will look into that. Thank you, Todd. Right now, there are no plans to expand there, but we can expand anywhere if there's a great opportunity and a great market. So we're happy to look into that. And with that said, I think, oh, wait, one more. Oh, we got it. That was the same one. So we answered that. So I think we got through all the questions right on time. Let me just make sure. Yep, that's an answer. That's an answer. Thank you for that. I answered that one. Okay, we got through all the questions. So great call today, Doug. Really appreciate you, Scott. If you want to pull up our contacts live, I'd like to get that out to everybody. You know, again, you'll see this, you'll get a copy of this call. We're always available to help. Our contact information is here. You follow us on all of our social medias. We do send out invites in multiple ways, so please make sure that you follow us. If you want to see an old SFR talk or any other product that we put out, it's usually on social media, especially YouTube. So thank you all for coming. Really appreciate it. Doug, thank you so much for joining. Great call today.